Welcome, everyone. Thank you for joining us for our latest Wealth Dimension webinar and kicking off the year of 2023 with us. Joining me today are co-founders Tom Curdy and Doug Loftus, as well as our investment specialist, Megan Bosco. We want to walk through a few items today. So on the agenda, some topics for discussion will be the 2023 key financial data, what you need to know about the Secure Act 2.0 legislation that was just passed, 2022 market recap, the economic headlines we're seeing and questions we're getting from clients around them, as well as what's Wealth Dimension doing to navigate the volatility and hopefully leave time for question and answer. With that in mind, please feel free to use the Q&A box down below and we'll try and answer as many as we can. And if we don't get a chance to get to you, we will follow up individually afterwards. A quick disclosure from our compliance team. I'm going to read you guys real quick before we dive into the presentation. We will be walking through some updates from new legislation and various charts and graphs for illustrative purposes. We encourage you to meet with an advisor to discuss your specific circumstances and financial goals. Another thing we wanted to discuss real quick is updates to our communication strategy with clients. We are always looking at ways we can enhance your engagement with us and the way we can dole out resources and communicate with you. So some exciting things we have planned. We're very excited to launch our new website here in Q1 of 2023. That will have additional functionality, a brand new look, as well as a streamlined way to view all the content we're creating. Speaking of that content, we're doing webinars like we are today, as well as videos from different members of our advisory team on questions we're getting from clients, topics we feel are relevant, as well as blogs and additional resources that we will be rolling out throughout the year and going forward. We continue to distribute these via socials and emails. So please follow us on LinkedIn, pay attention to your email inbox. We usually send these out about once every 3 weeks, a new video or blog post. So if you're not getting them and you would like to, please reach out to your advisor or any member of our team and we'll troubleshoot and figure out how to best to get that to you through our channels. So with that in mind, speaking of resources, one of the first ones we created for 2023 is this key financial data sheet. So what we did here is updated many of the new IRS limits and tax tables and things like that to go through it. Now, you won't be quizzed on this later, so you don't need your magnifying glass to look at it here. We have this in PDF form as well as hard copies here in the office we can share with people. But this is a two-sided sheet, and what I will do is go through some of the highlights here. So some of the key updates, everybody wants to know retirement plan contribution limits. So this is what you can contribute to different retirement vehicles. Really important things like your 401k, 403b, retirement, different company retirement things, you're going to want to get with your HR department, or many people have Fidelity Net Benefits or whatever system you are on, and update those because the elective deferrals did increase. So you want to make sure that you're getting the most out of those vehicles. Some key highlights are your IRA and Roth contributions increased to $6,500 this year. That is up $500 from last year. And you also get $1,000 catch-up contributions for age 50 and over. As I mentioned, your 401k elective deferrals increased to $22,500 this year. That's up $2,000 from 2022, and the over 50 catch-up is up to $7,500 from $6,500 the year before. Your defined contribution plan limit has increased to $66,000 from $61,000. And HSA contributions increased to $7,750 for a family and $3,850 for individuals. Other key items this year are the gift tax annual exclusion is up to $17,000. And what that means is each person, actually both spouses could do it in a marriage. They can gift up to $17,000 to family, loved ones, and those are exempt from gift and estate taxes. Tax tables are also updated in this. Your standard deduction went up to $27,700. That's up $1,800 from the previous year. and the filing single is $13,850 for this year. Of note, the 2022 tax filing deadline is April 18th, and then extensions from there. We have all the dates on the sheet for that. And then also includes things like updated tax rate schedules, Social Security benefits, and Medicare deductibles and premiums. As I mentioned, you're not going to be quizzed on this. This is stuff we always look at every year, reflect properly in our plan updates, and any opportunity we see with clients or colleagues, we're gonna roll those out to you in your next plan update and make you aware of those, how it might apply to you. So happy to share that with anyone who would like that after this, and we'll continue to roll out resources like that. If any of those numbers would change throughout the year, we will update this through legislation or other government action. We will update those. So the next topic we want to discuss is Secure Act 2.0, and Tom's going to walk you through what you need to know about this. There's a lot of provisions in there, but he's going to boil it down for you in some of the highlights.
Thank you, Eric, and welcome everyone. So many of you might know back in 2019, they passed the first version of the Secure Act 1. In 2022, this is the follow-up, Secure Act 2. And this is a bipartisan piece of legislation that passed overwhelmingly. And the purpose of it is, I think we're all aware that both employers and employees are aware of a burgeoning retirement crisis. Some of the statistics around that, half of private employers still don't have retirement plans. There was a study done in Boston College a few years ago where they identified a $7 trillion deficit in personal retirement planning. So there's a huge hole here. Congress knows it. They're trying to patch those things, and this is one effort to do that. So Eric, if you can go through to some of the provisions in this. The first one, so many of you are aware when you have an IRA, at some point, the IRS wants to collect the taxes that have been accruing in there. And so they trigger what's called an RMD, a required minimum distribution. This has traditionally been 70.5. Recently, it was changed to 72, and now they're on path to increase this. So starting in 1/1/23, they're going to increase the age to age 73. By 1/1/33, it's going to increase to age 75. This is dynamic. There's a lot of proposals on this. Not exactly sure what the end date's going to be, but right now they are elongating that to give people more time to save and accrue and defer until they have to start taking these RMDs and paying the tax. Now, if you're 72 in 2022 or earlier, the old rules will still apply. The next thing is, many people don't know this, but these required distributions, if you don't take them, the IRS is able to charge a 50% penalty. I don't think my colleagues and I have seen one assessed, but we really don't want to test that. So we're very vigilant every year to make sure everybody properly takes their RMDs. So the good news is they're reducing this from 50% down to 25, and that's going to start next year. This January of this year. One other provision in Roth, there are Roth 401ks. Traditionally, we're used to ones where you get a tax deduction on the way in, you get deferral, and then when you retire and roll to an IRA, then it's taxable income. Along came, after the fact, Roth 401ks that allow you to save with after-tax money, but the money accrues tax-free. Regardless whether you have a pre-tax or a Roth, they had RMD requirements on Roth pools of money. Starting in 2024, they're going to exempt the RMDs for Roth participants. Moving on here. Okay, catch-up provisions. So as we said, we have a retirement crisis and people are undersaved. And so this is an attempt to help people catch up, frankly. So by 1/1/25, this is a little quirky, but starting in 2025, for those who are between age 60 and age 63, the IRS is going to allow you to put in $10,000 in a catch-up. And it's presently at $7,500. This won't kick in until 2025. After they have this one-time index, then they'll start to index it for inflation going forward. Now, the one catch here is that if you make more than $145,000 in the prior year, that catch-up has to be in Roth contributions. And the spirit of that is the IRS is trying to work with us, but they do want to collect the tax from your wages before you put the money in here and accrue it. So it's postponing it's postponing the tax for you, but speeding up the taxes for them when you contribute. Then moving on to IRAs. So in personal IRA accounts, the catch up for those 50 and older is going to be indexed for inflation starting in 2024. Currently, it stands at $1,000. So if you can move on, Eric. Moving on to another area of RMD talk. So when you take your required minimum distribution, and as of 2023, if you're 70 and a half and older, you can use some of your RMD to do what's something called a qualified charitable distribution, or QCD. That's been in place. The change in Secure Act 2 is to allow a one-time gift up to $50,000 into a charitable trust of some sort. Now, a charitable trust is a way to give to charity while creatively using the assets for tax benefits or income today. So that's one change to it, and it's limited to $50,000. Moving on to the next. Now for employees. So as we said, 50% of employers do not have plans, and the IRS would like to change that. So they are trying to incentivize employers, and they're also trying to help employees for those who do have plans. So for starters, starting in 1/1/23, if an employer matches 401k, they can now match those contributions in Roth. Right now, or before 2023, you can only do pre-tax contributions for a match. So that's something that I think will benefit a lot of our clients. For employers, starting in for 403Bs and 401ks, starting in 2025 or after, they're going to require automatic enrollment for all employees who get into a plan. So right now, that's not the case. And all plans that exist now, it won't be the case. Some have automatic enrollment already. But as of 2025, if an employer starts a plan, they're going to require that you have an automatic enrollment of at least 3%. This is, again, to get people to save for retirement. Starting in 2024, for those who struggle saving, many times throughout the years, my colleagues and I have found that people want to save for retirement, but they're just not able due to circumstances. So some of these things in Secure Act 2 is meant to give a little relief there, yet getting on the path for saving for retirement. The first is an emergency savings account option. Now, this is for those who only have so many dollars, and they're giving them a way that they can make contributions. Now, they're going to be considered Roth contributions, and you can have a limit of up to $2,500 annually. But in an emergency, if you do need to take the money out, you can take that money out tax and penalty free. Now, there's 4 withdrawals per year in this plan, and this is also eligible for an employer match if they choose to. Also, starting in 2024, employees will be able to match employee student loan payments with matching payments to retirement plan. Again, if you're a young employee, you'd like to save for retirement, but you're burdened by student debt. This is a way to kind of capture this in a way so that you can make a student loan payment to reduce debt, but then that allows your employer to match that in a retirement plan to get you started. Moving on, Eric. And last, in 529 plans. One of the things that people ask us all the time is what becomes of 529 assets if you don't specifically use them for schooling? Well, this is a way to capture this for retirement. So after 15 years, these assets that are 529 could be rolled into a Roth IRA for the beneficiary. Now, the rollover is subject to the annual Roth contributions, and there's a cap of $35,000 ultimately, lifetime. And this Secure Act 2 has about over 100 different provisions in it. We've just captured a few of the highlights for you. And as always, when things like this happen, we quickly try to be conversant in it. But these are personal issues. So throughout the year, we will definitely, in the regular course of our meetings, make sure that we engage you in all the things that you could do that relate to Secure Act 2.
Yeah, Tom, and I think that's especially important for our business owner clients on that section. There's a lot to that and things they might want to adopt. So thanks for walking us through that and answering some questions. Like you mentioned, we'll follow up individually with those who it affects. Megan is going to take this next session. So she's going to walk us through the 2022 market recaps, how the movements in the equity and bond markets were, and walk us through a few slides on that process. Megan, take it away.
Great, thank you. Good afternoon, everybody. Thank you. This is my first webinar here at Wealth Dimensions, and I got a doozy of a year. Not like to be the bearer of bad news, and certainly do not like to show all red arrows indicating down markets for 2022. However, I'm just a delivery person here. Starting over, looking at the right side, focus on the bond market. I'm showing the U.S. bond and global bond market both down. If I look at the U.S. bond market down 13%, the worst year on record as measured by the Bloomberg aggregate index. What can we say about the bond market this year? Certainly, we had an active Fed raising rates 7 times, starting at the beginning of 2022. We were on the upper range of 25 basis points, or 0.25%, ended the year at 4.5%. It's one of the sharpest increases that we have seen on record again. And as we know with bonds, bond prices are inversely related to rates. So as a rate rises, bond prices go down. Hence, we have this very disappointing performance for intermediate bonds and in general, the U.S. bond market. If I go over to the left and start looking at global real estate, emerging markets, international and U.S., unfortunately, all again still red. Global real estate challenged by the rising rates as well as economic conditions that affected supply and demand. Hence, we have a down year. Looking at emerging markets, a different story. While emerging markets was underperformed the U.S. stock market by a smaller margin, certainly we had the story at the beginning of the year with the Russia invading Ukraine. We still had ongoing COVID restrictions, particularly in China. Their zero COVID policy impacting the Chinese stock market and the Chinese economy, and being the largest component of an emerging markets stocks certainly did hurt. And hence we had that down year, although they did claw back some return in the fourth quarter. International developed stocks, so we're thinking Europe, Japan, obviously with the euro, with the UK and Canada, outperformed the US market this year in 2022. The last time the international had outperformed the US stock market was in 2017. It was certainly a rough year internationally, same challenges as we will discuss in more detail later, but some of the challenges internationally that hit the US, rising inflation, rising rates by central banks, certainly rising energy costs, but it's part of the inflation story, geopolitical risk. Obviously in Europe, you had very close, they're obviously closer to the Russia-Ukraine crisis, so certainly a lot of negative impacts, but they were able to outperform the US market. Particularly, they made this up in the fourth quarter, primarily due to a weakening dollar, and we could talk about that, and we will talk about that further, but that certainly was a tailwind for international markets for the year. Now, the US stock market, this is measured by the Russell 3000 index, which is the 3,000 companies in the US stock market. We don't see this index a lot in the headlines, but it does align very well to S&P 500. The S&P 500 for the year was down around 18.8%, primarily due to those challenges talking about rate rises, inflation, risk of recession. Certainly, we had increased volatility in the US and globally in all major asset classes. And so we do see that it did claw back from the low of 25% that we hit kind of late summer or September. It did claw back in the fourth quarter. We did have a great 2 months in the US in particular, with some earnings, some positive economic news that did help to claw back. So we did not end, by definition, in a bear market for the US market for 2022. Eric, if you slip. This is some more detail on the US, some of the trends that we saw in 2022 that are I guess, a silver lining, if you will. We did see value outperform growth. Those value stocks, those are usually kind of lower price to earnings of stocks. We see it in energy, materials, some certain sectors that certainly have done well in 2022. They outperform the growth stocks, or those, particularly those growthier stocks that had done well after the pandemic, by a margin of, we had value at down 7.4%, and large growth down to over 29%. So certainly we were able to make up, if you are a value investor, have larger exposures to the value side, which Wealth Dimensions we typically do, we were able to outperform on a relative basis. Small caps, while they underperformed large caps, they did not do by a large margin, and we had the same value growth story where small cap value outperformed small growth. The same story where we're seeing growth. If you go to the next slide, please, Eric. The headlines, certainly, as folks are aware, the names that had done well, those high quality names, particularly from the COVID and after the COVID pandemic in 2020 and beyond, with the tech story and high quality companies, underperformed the general market, with Facebook or Meta leading the charge, unfortunately. So that drove a lot of the performance that we saw in the Russell 1000 growth, or the growth themes, as well as the S&P 500. And so again, I love that the headline, "Tech Giants Defanged," is certainly a story that we're seeing from a growth to value trend reversal that we will discuss more.
Awesome. Thank you, Megan, for walking through that. In this next section, what we're going to do is walk through some of the headlines we're seeing, questions we're getting from clients around them, and really where we see that they might be going in 2023 and how those might impact you. So the 6 areas we wanted to focus on were geopolitical issues, inflation, supply chain and global deglobalization, monetary and fiscal policy, debt and deficits, and recession risks. And Tom and Doug will walk through several of those, and Megan will lend her opinion on a few of them and comment. So we'll jump right in. Doug, can you walk us through really some of the geopolitical headlines we're seeing, what we saw in 2022, as well as what you foresee could affect the market in 2023?
Sure. Thanks, Eric. And again, welcome to everybody. Geopolitical risks probably were the headline, obviously on a global basis in 2022, and actually continue to be in 2023. Obviously, the biggest would be the Russia-Ukraine situation. It's kind of engulfed the entire world. We've created alliances and in some cases, strange bedfellows, but that is going to continue, it appears, to dominate 2023 as we move forward. That struggle has drugged through the winter, probably become more active as spring emerges in Ukraine. I think the offshoots of that conflict, one of the biggest ones being energy. Russia is a huge supplier of energy to the world, especially to Europe. The largest supplier of natural gas to Germany, one of the industrial giants of Europe. And I think that pressure is going to continue to evolve. I think there's an upside and a downside potentially. That will come to an end at some point as we move probably later in 2023. And it will either be resolved through there's multiple kind of potentials. One could be some sort of detente or agreement for Russia to take a portion of Ukraine or no portion of Ukraine. Ukrainians seem pretty set on that, but it could come to some sort of resolution in a peaceful manner. Probably the worst outcome is that Russia's concerned, as we all know, about an existential risk. They've been threatening more recently over the issue of tanks being supplied to Kiev. In the short term, threatening Germany, Poland, that potential action and threatening even countries outside of Ukraine if they continue to support Ukraine. So I think that is going to be a risk as we go forward. I think none of us are in a position to project an outcome, but certainly something that on any given day. But the world's been through conflict before. We've been through world wars, we've been through Vietnam, we've been through both Russia and the US long drawn out affairs in Afghanistan. We've had the Middle East conflict, and eventually they will come to an end and ultimately will not be the focus of markets. Although this one will probably have a longer impact as Russia is kind of sidelined from the global economy. One of the issues, I think, involvement of China and India with Russia is probably elongating this, and where that goes remains to be seen. The other issue that I think is a longer term is what are the concerns with China, both from a cybersecurity element as well as what's going to happen with Taiwan. We know under the Trump administration, they slapped 25% tariffs on a lot of Chinese goods. Subsequent to that, there's been technology bans. Anything that has any potential military use is chips and other items have been banned for export from China, intellectual property. And we have the continuing threats of the kind of one China policy with aggression coming from China, flying planes and ships, planes over Taiwan, ships circling Taiwan. And we're actually even seeing that in the fact that Taiwanese companies, and I'll talk about this in supply chain, largest semiconductor manufacturer in the world is Taiwan Semiconductor. They're now building plants in the United States for several reasons, one of them being geopolitical risk. So we've got some uncertainty going on in the United Kingdom. We've got a Middle East situation. And again, I think we're at a period of heightened geopolitical issue. Hopefully we'll see some resolution in 2023 as a backdrop. I think the economic fallout from these are the bigger impact than it is actually the conflict that is present. And then we can throw in, when we talk geopolitical, the US has its own political issues. Right now, we've got a change in Congress and potentially a budget battle coming up, or a debt ceiling issue coming up in Congress. The Republicans are pushing hard to get the Democrats to rescind some spending increases that were built into the budget that was passed last year. And that looks to maybe be a showdown. Rarely have we gotten to a point where it threatened the US's ability to pay its bills. Treasury Secretary Yellen has already highlighted the risks of to the ratings of the US debt. If we recall, it wasn't that long ago that the US did go into a shutdown, and actually S&P lowered the credit rating of the United States on that basis. From a domestic perspective, I think we would view that as the biggest short-term risk to the markets. If there is a prolonged confrontation over the debt ceiling, and the Republicans use that to rein in spending, and we'll talk about debts and deficits in a minute, but I think that conflict on a domestic basis is something that we're certainly keeping our eye on as we head into the middle part of the year.
Thanks, Doug, for walking us through that. Another headline, and probably what we get questions the most from clients, is inflation. In fact, Doug and I did a longer version of this in a video going through in detail over the summer when inflation was soaring. Doug, can you walk us through some quick updates? We have a few slides here on where inflation is.
Sure. Yeah, inflation certainly has impacted all of us. Most recently, eggs are up 60% in price. Energy is up. Housing is up. And so, we haven't seen, this chart shows what CPI has looked like over the last 50 years. Some of us are old enough, looking through the list of some of the people listening, to remember Tom and I started the company not shortly after we saw a peak in inflation where we had 13% inflation back in 81 and 82. And very few people remember that we had double-digit inflation, 13% back in 74 and 75. But we've gone through a long period of time, as you can see, where inflation has run under trend. We have always maintained, and for anybody that, we've run your plans, we project a 3% long-term inflation rate, even though the average for the last 20 years has been 2%, because the risk exists and you don't want to undershoot. As you can see in 22, we've seen inflation up at 9%. And that's probably going to be a bit sticky. The components of that, food prices were up, housing prices were up, energy prices were up. Virtually every component of the cost structure was, cost of goods was up in 2022. And so if you remove if you remove food and energy and you just take core, it was up slightly less in 2022. But the Fed understands the corrosiveness of inflation. And so they've been very aggressive, as we'll see, with interest rates in trying to bring this back under control to the 2% target. I think this is going to be persistent, maybe not at the levels we've seen recently, but we probably will settle at the 3 to 5% for a while. Wage costs have gone up. We do have a structural employment problem in this country, in that there's not enough people willing to work. The labor participation rate has continued to decline. People left the workforce during COVID and never came back. Some retired. Some left the workforce to take care of children at home that had no alternatives, and they've largely a large number of them decided not to come back to the workforce yet. Now, ultimately, they may be driven back. And then the other component to employment and the available worker pool is immigration. And I won't get into that subject. That's a long one. But, in some of the lower skilled workers came through immigration. And I think that's also been a component. And again, we just, again, from our perspective, a reasonable immigration policy, well thought out, needs to be developed in the United States. It's just that I don't think there's any political agreement that's going to allow that to happen in the short term. Where does inflation end up showing up? It ends up showing up in bond prices. So as Megan talked about, the longer term bonds that you own, when interest rates are going up, that causes the value of the bonds to go down, the market value of the bonds, not necessarily maturity value. But what we saw was rising rates across the board. It was 2.5 years ago when the 10-year Treasury was yielding 0.42%. Now it peaked around 4.5. It's dropped a bit down to 3.5 currently, but longer term bonds trade on inflation expectations. And interestingly enough, what the bond market is telling us, Eric, if you would flip to the next page. Yep, one back. Now short-term bonds, the 1-year bond is yielding about 4.75 and the 10-year bond is yielding 3.5. What it's telling us is they expect the Fed to be aggressive to bring inflation back under control, and they're actually telling us that they likely will bring it back under control, because 10-year, 20-year, and 30-year bonds, while they're up off of historic lows, are lower than the short-term bonds. And you can see here, we all got carried. We've seen really, really low interest rates since 2008, when we saw the financial crisis. We ran at 0 for a long time on the federal funds rate. But the long-term average over 50 years for both 2-year bonds and 10-year bonds is in the 5s. And the benefit from that is that while we struggled to find yield in the fixed income part of portfolios, this has actually been some relief, because now we can put money into bonds and even money markets, which are yielding a lot. It's very rare but the best asset class, the two best asset classes in 2022 were short-term bonds and cash and energy stocks. Those were the only, energy was the only asset class that was up. So again, I think we're looking at inflation will gradually come under control, and the Fed is likely to remain diligent and probably a little bit more diligent than the market is giving credit.
Thanks, Doug. And again, we have a video on that that we can share with anybody interested that walks through how that also applies to your personal circumstances and how we modeled out in a plan. The next section, and again, all these are interrelated. So probably touch on a few of the pieces from the first two slides and what the next three topics are. What will fit in there too. But Doug, can you walk us through some of the supply chain headlines we're seeing and the concept of deglobalization?
Yeah, so I'll be real brief here, but obviously everybody knows that we went through COVID, which disrupted global supply chains. Still have an issue out of India, out of China. And so we've seen supply chains, and that is where do the raw materials and the intermediate goods come from that create finished products. We've been in 40 plus years of deglobalization, and lowest cost provider has been the mantra as we globalize and jobs shifted out of the United States and went overseas because labor was cheaper, raw materials in some cases were cheaper. But now companies have learned the risk of just-in-time inventories coming from all parts of the world. And those supply chains caused rapid increases in prices as inflation comes partially from supply and demand. And when people demanded goods, but the supply wasn't there, those goods that were there went up in price to meet the demand. Automobiles were probably the best example of that. We talked about, tens of thousands of automobiles parked because they were missing a couple chips. Automobile manufacturers quickly rebuilt their designs with chips they could get. In a lot of cases, that's good and bad. A lot of people don't realize that there were old chips put into new designs just to make them work, and so they could push product out. What we've seen now is nearshoring, right? And so nearshoring is, okay, I'm going to move my manufacturing of my products from Asia, which is where it's been largely held, to Mexico, some to Canada, a bunch to the United States, so that the interruption risk of my supply chain is not as great going forward. So we're deglobalizing at this point, which again, will add to some costs that will create a little bit of persistent inflation. It is more expensive to build goods in the United States than it is in the lowest cost countries like Vietnam or India. And that will take a period of time to rationalize. So it's probably going to be a decade that we're going to see the effect of that. But you can see Intel, many of the foreign chip manufacturers are now building plants in the United States over the next 5 years. So we are seeing a deglobalization, which will bring more supply chain security, but will also probably have a little bit of price pressure attached to it. It will also create a demand for labor in the United States because as we onshore a lot of this work that was exported, you're going to have, again, probably some wage pressure. We're still seeing that in a persistently low unemployment rate.
Thanks, Doug. Now, can you dive next into some monetary and fiscal policy and the actions we're seeing around it?
Yeah, so this has been a big topic of discussion, and that is monetary policy is what the Fed does through controlling money supply, interest rates, and their balance sheet. Fiscal policy is what Congress does, basically. It's what the government does through regulation. So everybody knows that the Federal Reserve in 2008 went into a massive monetary stimulus program, largely because we had a dysfunctional Congress and they couldn't agree on fiscal policy. So there was no help coming from Congress to help. So the Federal Reserve lowered interest rates from 5% essentially to 0%, 0.25%. And we stayed there for a long period of time until about 2017. And the economy started to recover. and the Fed started to raise interest rates, and got to 2018 when they became more aggressive. It looked like 10-year rates were going back to 3.5%, and in the fourth quarter of 2018. When the Fed started to become more aggressive, became somewhat overt about their plans, or more pronounced, the market tanked 20% in the fourth quarter of 2018, and the Fed stopped. And you can see they stopped raising, probably prematurely at this point. We went through 2019, then COVID hit, and we went right back down to zero on interest rates. And so you can see, as Megan mentioned, we've had one of the steepest increases in federal funds rates in history over 2022, where we've gone from 0 to 4.5%. I think our expectation is that the Fed will probably go another 50 basis points, or 0.5%, and then become data dependent. I think what they're likely, though, to do is keep rates at that level for a longer period of time until they're sure that they brought inflation under control, which they may or may not totally get to their 2% goal. But I think they also have a credibility issue. And I think we will also next year be heading into, in 2024, into an election year, and I don't think they're going to want a significant policy change. So we expect to be able to capture these higher yields as a result of the federal funds rates, at least for a couple of years. We would hope to support the fixed income side of portfolios. On top of that, the Federal Reserve, starting in 2008, took their balance sheet from $700 billion to a peak to a peak of $9 trillion in 2022. What that means is that the Fed was buying up all the bonds in the market, or a large portion of them, not all of them. Supply and demand, when you've got an artificial buyer in the market, it compresses interest rates. You've got more buyers than you do issue or bonds to buy, then it drives interest rates down. In 2020, they stepped in and bought stuff they've never bought before: municipal bonds, junk. They announced they were going to buy junk bonds. And they didn't actually have to do it, I don't believe, Megan. But again, we've seen just a massive, unprecedented involvement of the Fed from a monetary policy perspective. They're trying to normalize. With interest rates, again, I'll go back to the 60-year average on the 10-year Treasury is about 5%, even though we've been incredibly low for the last 10 years. So they're not doing anything more than normalizing rates. And so, again, hopefully that will continue, and fixed income in the portfolios will continue to generate a return. We are in a somewhat unique time. The top graph shows the average rate over the past 10 years on the bottom one, and what each of the bonds yielded. Currently, as I said, short-term rates were in what's called an inverted yield curve, where you get paid higher interest for a one-year bond than you do for virtually anything else longer. And that, again, is predictive historically of recession. And that's why, and in fact, we were at record levels from the difference between the 2-year bond versus the 10-year bond. That's why you hear so many people talking about recession, and Tom will talk about that after we get past this section. One comment on fiscal policy: the government, the Congress decided to finally act throughout the end of the Trump administration and the beginning of the Biden administration, and dump $3 trillion into the economy. So we're, again, looking at where we are recession-wise. You can see this big spike. This was personal savings. For a long period of time, personal savings had been declining. And then all of a sudden it spiked to unprecedented levels, way beyond any historical norm. But as stimulus came to an end, people spent down. That savings, now we're again at a negative. We're at a very low savings rate on a historical basis.
Thanks, Doug. And the last section for you, can you walk us through how that how the 4 sections you've covered feeds into debts and deficits?
Yeah,
Doug,
so this,
and before you do, excuse me,
Go
so
ahead,
you
Tom.
want to make a comment about just the monetary policy itself, the fact that zero bound rates is not healthy for the economy and certainly not for savers. So you might want to comment a little bit about how we celebrate the normalization of the yield curve.
yeah, I think that is very clear. It was not that long ago in 2020 where government bonds around the world had a negative yield. What that means, and we talked to many of our clients about this. If you buy a government bond for 100,000 in Germany, at one point at the end of the 10 years, they're going to give you $91,000 back. You're going to lose $9,000 because it had a negative interest rate. Economic systems around the world have never contemplated a negative cost of funds. As those rates are really low, you get inflated asset prices as a result. So as they've normalized, asset prices have adjusted. But as Tom mentioned, again, I'll reiterate that there is a very strong silver lining in this, in that, you know, our fixed income holdings, our bonds and instruments that we have in the portfolios that are diversifiers are now yielding 4 to 5%, which is, again, for a portfolio that has an allocation to bonds, that is a really, really welcome relief. In addition to that, risk-free investment in treasuries tends to be a driver of returns of equities. And so you get what's called a risk premium. Each asset class has its own risk premium. And so if the 90-day treasury bill is yielding 4, and you get a 5% equity premium over time, you would expect stocks to yield 9, to return 9 over time. And again, I won't go into the details of capital markets here. We'd be here till 3 o'clock. But it is a silver lining in these rising interest rates. It's not great if you want to buy a house and you can't get a 2% 15-year mortgage, and that will have an impact on housing. But there is a silver lining for investors and those who are saving money.
Awesome. Thanks, Doug. And yeah, diving into a quick debts and deficits, we're running close on time.
Yeah,
So
I will hit that real quick. So debt, again, some of the concerning factors we're looking at. This is a look at U.S. credit card debt. You saw the savings rate falling. So we can see in 2008, in the middle of as we approach the financial crisis in 2008, we saw a peak in consumers using credit cards to pay bills. We saw it again in 2020 with unemployment as people lost their jobs due to COVID. Then it dropped dramatically, but not to a really low level. And we're now seeing, as of late, we're seeing those credit card balances rise once again. So that is concerning. Household debt, again, is rising. That continues to rise. This is a combination of credit card debt. This is mortgages, it's car loans. We look at statistics like the average size of the average car payment, how long car loans are now at the longest amortization length of the loan they've ever been. We're up 84 plus months now to pay off a car. We also watch things like delinquencies, what's happening with people's ability to pay, and those are all indicators. On top of consumer debt, you know, obviously the government now has $31 trillion of debt. If the average cost of funding debt is 3.5%, we're talking about $1 trillion of interest payments. Comparing that when the government was funding at a rate of 1.5% and had 25 trillion of debt, you know, that cost at the time was about just a little under 300 billion. So the government is dealing with another $700 billion of interest payments just to fund the current debt. These are all things that, again, this fight in Congress that's likely to emerge is real, and it's needed. I mean, we need to bring spending into a reasonable level, and that again is going to be headline risk as we go through, and probably into 2024 will be a challenge as we head towards the presidential elections.
Thanks, Doug. So
if you would back up one point, right? All of this comes into consumer sentiment, right? I mean, all of these things that we've talked about on global risk. Tom will talk about recession real quick in just a second, but this is a slide I love, and that is when things are good and when things are bad, right? And so this is a graph that looks at consumer sentiment as measured by the University of Michigan, and they're probably the most well-known, one of Megan's prior employers. One of the things that you'll notice here is that if you look at consumer sentiment, if you go 12 months out, each time the consumer sentiment peak, that means everything's fantastic, we're all in jolly land, right? The average return of the S&P 500 12 months out was up 4.1%. If you look at the troughs, these 8 troughs across here, and this is when things seem terrible, right? Consumers think the world's falling apart. We all think the world's falling apart. It usually coincides with a market decline, unemployment rising, a variety of factors, and it all forms our opinion and the population's opinion. The average return in the S&P 500 12 months out from the trough of consumer sentiment is 24.9%. So when things feel the worst, right, we continue to encourage people, when they feel the worst, it's probably the greatest opportunity. And I will just speak the last comment on that. We review Vanguard, JP Morgan, a whole bunch of capital market assumptions. And that is the projections of what the long-term rates are in all kinds of different asset classes, large company stock, small company stock, bonds. A year ago, when we reviewed these in our investment committee, expected returns for US stocks were between 4 and 6% for the next 10 years. And these are round numbers. Don't quote me on these. Compliance and legal won't like me putting numbers out there. When we look at them this year, they're around 8.5% for stocks. So this market decline, and that's over a 10-year period of time. So while things feel bad, there's a lot of headline risk, there's interest rate risk, there's inflation. Actually, the opportunity in the markets appears to be much better now than it was even a year ago. So
yeah, and that's when there seems to be big headline to the negative side, that's where the most opportunity is, and where good news comes out, obviously that's going to make the market go up. So Doug, thanks for sharing that piece with us. The other headline risk we want to cover today is recession. Everybody's worried. Are we in a recession? Are we headed towards a recession? Tom, can you kind of walk us through A, where we stand today, and B, lend some perspective in your years of experience and being through a few of these at this point?
Yeah, so that's a $64,000 question, and it's something that we see every day ad nauseum. I would say that this is, if we do have a recession, or if we're in one now, this will be the most highly broadcast recession probably in history. So it's something that's on the news every day. The National Bureau of Economic Research, the NBER, is the actual official arbiter of it. It's a private organization that's nonpartisan that gets to decide if we are officially in a recession or not. Typically, our experience has been by the time that the NBER declares there's the recession's in the rearview mirror. So we don't get too tied up on the academics of whether we are or not, but we did want to lay out a few scenarios that we think might happen. So scenario number one, and this has a lot to do with some of the Fed policy that Doug and Megan talked about before. So right now the Fed is got its foot on the economy's throat. They're trying for an outcome. Their charge is one of two charges. One is full employment. The other one is to tamp down inflation. Inflation's become a problem. So this is job one for them. This is, as Doug mentioned earlier, this is the highest slope of interest rate increases in history, even more than Paul Volcker's Fed. So this has been significant. It's been a little disruptive to the bond market, but in the end, it's going to be orderly and we celebrate it. So as it relates to recession, the Fed is using some very crude tools to try to create its outcome, being tamping down inflation. So the first scenario is going to be that they get it right, that they use a very crude tool to surgically cause the so-called soft landing. That soft landing is merely that the economy slows down, but we don't actually go in recession. And we successfully tamp down inflation. If that's the case, one could argue that the market's already spoken, the damage has been done, we're probably basing and possibly on our way to the next bull market. Scenario number two is they don't get quite that lucky. They do They do cause a mild recession, but in doing so, again, mission accomplished. They tamp down inflation. Same scenario, in our opinion, is that the market's probably already priced that in and we're bumping along the bottom. The third and the more caustic scenario that could happen is that the Fed does all the things that they're trying to do to tamp down inflation, but they find inflation to be stickier than they thought, per some of the comments that Doug made, some structural employment, immigration, et cetera. And if that happens, then they don't get the outcome that they need. And in doing so, they're going to be longer and more severe with their interest rate cycle. That could cause a more serious recession and a longer recession. If that's the case, it's a possibility we could go back down and test those June lows of last year and maybe then some. So we're not predicting any of the three. We're just saying that there's a probability of all three. Most likely it's going to be one or two, but it is very data dependent, and it's really kind of up to the Fed at this point in the markets. You might want to shift to that. Thank you, Eric. So we don't know what this one's going to look like now. If you look at the bottom on January 2022, it looks a little garden variety at this point in terms of max decline. There's been some other more caustic ones. The Great Recession certainly was the most painful in our recent history. So there's one, but at 24.5, it's kind of middle of the pack. And then we don't have any idea exactly where we are in this cycle, but just to give you some reference points on prior ones, the number of months to max decline, you can see that the highest one was 25 months, the lowest one was 1 month. And then the number of months from a 20% decline to the max decline, again, in 2000, the so-called dot-com bust, there was 19 months in there. And the number of months from max decline to recovery, again, it's not to be known yet, but the worst one of those, again, was the dot-com bust that actually took 3 years for the markets to digest. So big question mark right now. We're hopeful. And as Doug said before, a lot of things have done. And Megan made the same comment about the markets and some of the stocks that have been repriced, and the market is normalizing, and we are hopeful that we will continue on and eventually get into recovery.
Great. Thanks, Tom. And real quick, what we're going to try and dive into in 5 minutes is, what is Wealth Dimensions doing through this? What is our investment methodology? How do we navigate during times of high volatility? And we're going to walk through a few of those strategies. So the first one is aligning your risk and reward inside of your plans as it relates to cash flow. Doug, can you walk us through real quick a quick version of your take on that?
Yeah, so this is a critical part, right? Everybody can invest, but your investments need to be tied specifically to your plan. What are your personal circumstances, your tax circumstances, your earnings and your cash flow, and your expenses? So can't understress the importance of having a detailed plan. This is not a average rate of return, average expense, will project some inflation. This is a deep dive plan that most of you have, that we've worked with you to build to help inform the decisions that we make on your own portfolio. We don't use a cookie cutter approach. The goal is to make sure that your plan and your portfolio is coordinated with your individual circumstances and cash flow situation. What's the appropriate amount of bonds? What's the appropriate risk exposure? Do we have enough to fall back on if this is a prolonged decline in the markets? And again, I'm just stressing the importance of having your portfolio coordinated with a detailed and comprehensive financial plan is critical. That's first and foremost.
Thanks, Doug. Yeah, those back of the napkin plans, or garbage in, garbage out, is what we like to call them. It really needs to be tied to a detailed cash flow based plan. The next strategy we deploy is just really proper diversification inside of a portfolio. Tom, can you walk us through real quick your perspective on that?
Sure. So for all of our clients, you know that the way we build portfolios is to start with equity diversification. We know there's a number of markets around the world. We touched on it, the so-called quilt chart that kind of shows that assets go up and down all over the world all the time, and not in a very orderly fashion. And so we first seek to get proper equity diversification among asset classes, and those might be large US, small US, growth, value, international developed, international emerging markets, and real estate. So having proper equity diversification either reduces volatility or it increases returns. We start there. Second is we have, for our anchor or our ballast, we have a fixed income strategy. We have some strict rules around that as well. But the purpose of the fixed income strategy is to be a ballast when equities are out of favor. And so we gently move from one to the other, either asset class to asset class or from stocks to bonds, bonds to stocks, according to what happens. We're not predicting, we're acknowledging and then making strategic moves accordingly, which brings us to the next, which is rebalancing.
Thanks, Tom. Yeah, and you touched on it a little bit, but Megan, can you walk us through a little bit of our rebalancing strategy?
Yeah, if you would put up that patchwork quilt chart really quickly that Tom was referring to. This does tie really well into our rebalancing strategy, as Tom was talking about, particularly within the equity portfolio, the different asset classes that we deploy in the portfolios. We can really take advantage of either volatility in the market, meaning some of these asset classes, as you see in the light blue box, for example, REITs, we do have a dedicated allocation in most of our portfolios to public real estate. You can see in 2021, it was a top performing asset class. You can see the year prior, it was the bottom. How can we harvest that type of growth in our portfolios while also controlling for risk? And we do that with using rebalancing bands within portfolios that we can take advantage of some of these higher performing asset classes. We can trim positions and reallocate to lower allocated, or perhaps at the time lower performing, with the expectation of taking advantage of some of these opportunities in the market where they can outperform. Our goal in rebalancing, particularly in the equity portfolio, is to add to incremental return over time while also controlling for risk. Again, depending on the allocation and looking at the asset class, we want to take advantage of the momentum of those asset classes and taking some of those gains and reallocating, while also not letting those positions get outsized and controlling the portfolio. So it's twofold approach: adding an incremental return, controlling for risk. For a lot of our clients who've been in the last few years with this increased volatility for the various reasons that we just outlined, inflation, recessionary risk, all of those, we've been trading probably more than we would in times where we don't have these heightened market risks, or we're just taking advantage of some of those different asset classes and how they're performing in the markets.
Thanks, Megan. And I will take this last one for the sake of time. Last one we have is tax loss harvesting. During times of volatility, you have losses inside of positions. So different tax lots, when you bought at different times, it may have gone down inside of your taxable accounts. So these are your individual brokerage accounts, your joint brokerage accounts. IRAs and Roth IRAs are not included in those tax loss harvesting opportunities. But really what we're trying to do is capture a tax loss while not losing exposure to the market during those times. And what that does is we're able to use that against current and future tax years to offset the income generated from portfolios. So you don't lose exposure or the upside because we have proxies built in that we get out of one position and buy a similar position that captures that asset class we're trying to include in our portfolio, but allows you to take advantage of the tax loss and use it in current and future tax years. And our technology and our processes allow that to do that throughout the year. For instance, in 2022, for most of our clients, we did 2 or 3 rounds of that throughout the year. Whereas in a lot of other firms we see, they will do it, end of the year or when statements are about to come out to get some activity in there. We are able to deploy that while also capturing the rebalancing, the diversification piece inside of that. They're all intertwined, and our technology and processes allow us to do that.
I'm going to make
go ahead,
one
Doug.
additional comment. And then the other piece of it is many of you saw in your portfolios, we made strategic adjustments. So, we have adjusted exposure to growth versus exposure to value, exposure to small versus large, some of the international and emerging markets. Those are more strategic decisions. One thing that virtually everybody saw this year was as we saw interest rates rising, we cut back. We were always shorter. So if you saw the performance of the U.S. bond market, we were much shorter than on average maturity than the U.S. bond market average going into the year. And actually earlier this year, we shortened up even further. So we brought our, what do we come into, Megan, maybe a year and a half?
But around, yeah, around 2.
Around 2 years.
We cut
So
it down by a year and a half-ish.
we didn't want the exposure to long bonds in a rising interest rate market. So we cut, not only were we already shorter, but we even strategically made a decision to shorten that. So that's one additional thing, piece of portfolio management we use this year.
Awesome. Thanks, Doug. And for the sake of time, thank you for staying with us. We ran a little bit over, so we'll hold questions for now and follow up with those who asked them individually. One piece of advice I think we didn't cover it is what to do with some cash lying around. As Doug mentioned, things you're holding in cash for future purposes, things like that. We've talked about how interest rates have risen. We have money market vehicles now that are yielding for around 4% right now. So talk with your advisor. We can walk you through. We're having these discussions regularly in our plan updates. But any questions you have, please feel free to reach out to the advisors or our team individually, and we'll be happy to answer them. Any follow-up questions from this?
Eric, you might add there short-term treasuries in a lot of the portfolios for people sitting with money in the bank.
Yeah.
That's yielding very low amounts. Short-term treasuries for taxable accounts, especially for money sitting in an account, are yielding around 4.5%. And they are also state tax exempt. So in the state of Ohio, it's like getting another 25, about another 1/4% in yield because you don't have to, the interest is not taxable on your state income tax return.
Yeah. So a lot of opportunities out there rather than just sitting in a bank savings or checking account for money you're not going to need in the very near term. We have safe vehicles for that can give you additional yield. So yeah, again, as I mentioned, thank you for staying with us, and any additional questions or follow-ups. I know we covered a lot here, or any of the resources we discussed, we will continue to roll out. And stay tuned for our new website and all the additional content. We'll roll them out soon. Thanks and have a nice day, and Happy New Year.
Thanks, everyone.
Thank you.